Equity markets have experienced an extraordinary rebound since their drop in March. Yet economic data continues to lag. So the question investors are asking is, have markets gone too far? Today we're going to address the recent run-up in the market and give some context as to why it might be justified or why it might be overdone. First, the bull case. Many investors' fear quickly turned to greed since late March as markets rebounded substantially. So what are the things they're looking for to justify that optimism? The first, don't fight the Fed. The Federal Reserve has put forward substantial amounts of stimulus to help the economy. The second, reopen the economy. There's no question that market participants are betting that this is a manufactured recession. We had the ability to close the economy, therefore we retain the ability to open it. Now, recent job reports show that we're moving in the right direction, but there could be a long way to go. Last, vaccine and pandemic data. There's no question that the best cure for a pandemic is no pandemic. Globally, economies have been able to bend the curve, and positive developments have come from vaccine data. So there's no question those are moving in the right direction. Now on to the bear case. For those investors that are leery of the recent market run, what are the things they're using to justify that position? The first is stretched valuations. Valuations are a common way that investors use to see the attractiveness of a market. Lower valuations mean that a market is more attractive. Prices have moved substantially, but earnings of underlying companies have actually fallen during this period, leaving some indices to have above average valuations, even on 10 or 15-year metrics. The second concern is a second wave. We've been able to bend the curve once, but will it continue to bend? Or will there be a second wave, and will we have to move back to shelter in place, undoing some of the benefit of the recent reopening of economies? Lastly, economic data. It's hard for investors to reconcile the fact that unemployment is at multi-decade highs, but markets continue to trudge forward. So where do we go from here as the bulls and bears battle it out? At Azzad, we would offer the following. First, during periods of stress and volatility, emotions run high. Decisions based on emotion alone can often impair the effectiveness of a long-term strategy that's sound. So be leery of fear or greed driving the decisions you make. Instead, stick to the plan. A thoughtfully designed portfolio is intentionally built to accommodate long-term needs. So unless those needs have materially changed recently, having the discipline to follow through in uncertain times can greatly benefit your portfolio. Lastly, prudently diversify. In markets like this, where the bands of uncertainty around outcomes are high, a thoughtfully designed portfolio can help protect it in these uncertain times and keep investors on track. As always, should you have any additional questions, please feel free to reach out to your Azzad advisor. Thanks for watching.